Hello and welcome. If you're interested in investing but find the stock market a bit intimidating, you're in the right place. Today, we're going to talk about the investing principles of Peter Lynch, one of the most successful mutual fund managers of all time. Lynch managed the Fidelity Magellan Fund and achieved remarkable success by focusing on stock picking, research, and the power of compounding. Let's dive into what you need to know. First, why invest in stocks? Over the long term, stocks have historically provided better returns than other investments like bonds or bank accounts. The reason is the power of compounding. When you invest in stocks, your money can grow exponentially over time. But remember, the key word here is long-term. Investing in stocks is not a get-rich-quick scheme. It's about patience and a commitment to staying invested through the ups and downs. The stock market is inherently volatile. Individual stocks can fluctuate significantly, and the overall market can experience corrections and bear markets. Lynch suggests that if you can't handle this volatility, stocks might not be for you. However, if you can keep a long-term perspective, stocks can be a rewarding investment. Lynch categorizes stocks into 5 types. Fast growers. These are companies with rapid growth in sales and earnings. They're often in high-growth industries and can be very profitable, but they also carry more risk. Slow growers. These are mature companies with steady growth, often paying dividends. They're less risky but may offer lower returns. Cyclicals. These companies rise and fall with the economy. Timing is key with cyclicals, as buying them at the right point in the economic cycle can lead to significant gains. Turnarounds. These are companies that have struggled but have the potential to turn things around. They're high risk, high reward opportunities. Asset plays. These companies have hidden or undervalued assets like real estate or intellectual property that can unlock significant value. Lynch emphasizes the importance of doing your own research. Start by understanding the company's story. What makes it successful? Look at its products, services, management team, and competitive advantage. Analyze its financials, focusing on earnings, debt levels, and cash reserves. Check the price-to-earnings (PE) ratio to assess whether the stock is overvalued or undervalued. Timing is critical. Lynch suggests that the best time to buy a stock is when it's undervalued due to broader market declines or specific company-related news, offering a good risk-reward profile. Look for buying opportunities when the potential upside is high and the potential downside is limited. Remember, you don't have to buy a stock at its absolute lowest point, just at a point where the risk-reward balance is favorable. Volatility is part of the stock market. Lynch notes that significant market declines are normal, and you should be prepared to ride them out. The key is to stay focused on the long-term story of the company and not get distracted by short-term fluctuations. If stock picking feels overwhelming or you're short on time, Lynch recommends equity mutual funds. These funds are managed by professionals and provide diversification by investing in a range of stocks. However, remember that mutual funds are also subject to market risks and volatility, so choose one that aligns with your investment goals and risk tolerance. In summary, Peter Lynch's investing principles emphasize patience, research, and understanding the story behind each stock. Investing in stocks requires a long-term perspective and a willingness to endure market volatility. If you enjoy researching companies and following their stories, stock picking can be a rewarding experience. But if you'd rather leave it to the professionals, consider equity mutual funds for a more diversified approach. Thanks for tuning in. If you enjoyed the video, don't forget to hit the thumbs up button. Your support means a lot to us. While you're at it, subscribe to stay updated with our latest content. Got something on your mind? Drop us a comment below. We'd love to hear from you. See you in the next video, and happy investing.